Hi everyone, my name is Matt. I cover tech stocks for PSG Wealth, and in this presentation we're going to have a look at the Apple and Amazon June quarter results, which were released right at the end of July. So let's kick off with the executive summary, and the point of this slide is just to give you a summarized version of what's to come in this presentation. So very briefly, Apple had third quarter results, which showed relatively flat sales, lower operating profit, and net income and EPS that was down 10 and 7% respectively. The results were received positively by the market. They increased 3% after hours, and the year-to-date performance as of yesterday is now just about 5%. Then on Amazon, they had second quarter results, and those results were received even better by the market, with shares up 14% in extended hours trading. Amazon's results were not as bad as I think the market expected. They came in above the lower range of guidance, and the guidance given by Amazon was also above expectations. So sales increased 7%. However, operating profit was down nearly 60%, and earnings were down 126%. So we retain our calls on both of them. So that's a hold for Apple and a sell for Amazon. So just looking at Apple's results, the key takeaways were that the supply constraint headwinds were not as bad as previously guided. In fact, they came in above the bottom range of guidance. The company achieved a number of June quarter revenue records, which included records in iPhone and services, which are the biggest drivers. And then numerous records were also set geographically and within services. And then there were a number of iPhone units. The number of iPhone units sold grew by 1 million, and the average selling price increased by just less than 4%. The installed base is the highest it's ever been, and demand for Apple's products remains robust. The services business is growing well and contribute 25% to total revenue and have gross margins of 71.5%. So overall, results pretty decent given the environment. And then, as mentioned before, shares increased 3% in extended hours after the results were released. The results beat guidance, and the guidance suggested that revenue is going to be accelerating into Q4. Year-to-date, Apple has been one of the best performers out of big tech for the year. In terms of valuation, we use a simple PE method to value Apple, and the multiple we use is derived by applying the peer average for the traditional business and the services business in a ratio of 75-25. And we think that this value for Apple is quite full, and it's at about fair value. We recommend holding it. Now, moving on to Amazon, we've got revenues that were driven by cloud, which grew 33% and contributed about 16% to revenue. Revenues were above the upper end of guidance, and then also cloud contributed the majority of operating profit. Advertising revenue grew 18%, which is a lot faster than the likes of Google and Facebook. But just remember that it's still a relatively new business, and it just highlights the difference of the risks between growing off a high base and growing off a low base. Online sales declined 4.3%. Third-party seller services and physical stores grew 9 and 12% respectively. Overall, costs grew faster than revenues, resulting in a drop in operating profit. And then further, Amazon recorded nearly $4 billion loss from their investment in Rivian, which lost 50% of its value between the last set of results and the set of results. Amazon rose 14% in extended trading following the results. Even though the results are a little bit mixed, I think maybe the market was expecting worse given the environment. And then year to date, Amazon is about down 14%. This is as of yesterday. And then finally, just on the valuation, so the way we put a value on Amazon is to apply EV sales multiple, which is based on peers over a 5-year average. And we do that to each of the main businesses. But we do place a lot of emphasis on the quality of the business, which we view as quite poor compared to the rest. Some of the factors that contribute to the quality is the potential regulatory risks, which are still prevalent and quite difficult to quantify given the different countries that Amazon operates in, as well as the potential size of the fines that they could be subject to. And then, of course, they've got very low margins, which don't allow for much flexibility. And then the third component, which is in the report, is a reverse DCF, which basically uses the consensus forecast and shows the sensitivity to what exit multiple you use and which WACC you use. And it's clear that the valuation is quite heavily skewed to the downside. So all of these factors combined lead us to maintain a sell recommendation.